Welcome to FT Markets. The saga between Greece and its Eurozone creditors has taken another turn for the worse. Some speculate that the Greek government could run out of cash as soon as next week. Little wonder then that its government borrowing costs are in double-digit territory. However, unlike the crisis 3 years ago, other Eurozone peripheral countries have seen their borrowing costs remain relatively unaffected. With me to discuss why is Elliot Hentov, a director of sovereign ratings at S&P. So, Elliot, are investors simply not bothered anymore about the prospect of a Grexit?
Thank you, Chris. I think you just answered the question a little bit yourself by saying what's different from today than from 3 years ago. And there's two defining features that insulate Greece today from, or the potential of contagion that versus 2012. The first is that the financial sector is no longer exposed in a meaningful way to Greece. So a default or an exit, whatever scenario we can imagine, the contagion effect, the destabilizing factor throughout the financial systems across Europe, that is no longer the case. The second defining feature is that Europe has now built firewalls actively to prevent contagion. 3 years ago, we didn't have the ESM, which is now a permanent mechanism that basically establishes a very clear process as to how to support sovereigns that come under stress. We also have Draghi's famous whatever it takes statements, which means the OMT program. It's an untested program, but untested program. But that too, in a crisis scenario, if there was contagion. So investors know that, the markets know that. So those are two very key defining features.
The other defining feature, perhaps we'll see it if we come to our graph. Here we have the FTSE Euro First 300 index doing very nicely, especially this year. You can see that bump, and meanwhile the Athens bourse going the other way. One factor that has been driving the wider Eurozone returns upwards in equity and bond markets has been the launch of quantitative easing by the Eurozone Central Bank. How important is the QE program to giving investors comfort?
On top of what I just talked about, if you look at the chart here, in 2012, you see very nicely how the lines move in tandem in the middle of 2012 when the crisis was about to hit its peak. So the difference from today is the two features I mentioned earlier. But now you also have a third feature, which is there's some supporting factors such as QE. QE matters. I mean, we had a nascent economic recovery before QE was announced. So you already saw improvements, particularly in peripheral states such as Ireland, Spain, and even Portugal. QE is going to support that. And on the yield side, I don't know if we can pull up the chart for the comparative bond yields. And here you see it really nicely. QE further insulates the potential rise of further peripheral yields. One thing we don't see here, which is also very interesting, is in 2012, common depositors were fleeing their bank accounts. So Greeks were pulling deposits out, Italians were pulling it out, Spaniards were pulling out. You don't see that today. That's a phenomenon that's unique to Greece. All the other depositors have confidence in the banking system as a whole.
So do you think that QE, the ECB's bond buying program, it could act like an anesthetic for investors, insulating them from the pain of a Grexit? It makes it more manageable in one sense.
It's certainly one more pillar of support in preventing a rise in yields. And bear in mind, QE, the way it's structured and targeted, eventually it'll hit the ceiling of potential purchases as there's a limited supply of sovereign bonds eligible to be purchased. So that kind of puts a natural lid on a reverses of bond prices and bond yields.
Lastly, do you think it makes it more or less likely that a Grexit will happen soon enough?
I think the answer lies in Athens, in the corridors of power and political makings that I think neither one of us is privy to.
Thank you, Elliot. So there we have it, the QE bond buying program launched by the ECB in some ways perhaps makes Grexit more manageable. However, investors will be careful of what they wish for.